All right, let's dive in. Today, we are talking about a brand new income ETF that's been making some serious waves. It's called WPAY. Now, it promises something really tempting, a steady paycheck. But as you're about to see, it also comes with some major pitfalls.
So let me just start with this question. What if your portfolio literally sent you cash every single week? I mean, think about that. It's a really powerful idea, right? That kind of consistent cash flow has this huge psychological appeal. And that is the exact hook for the fund we're digging into today.
And the fund making this big promise is the Roundhill WeeklyPay Universe ETF, ticker symbol WPAY. The whole idea is to give investors that steady, weekly hit of income. But the real question is this some kind of breakthrough for income seekers? Or, is there a catch?
To really get what WPA is all about, we've got to put it in the ring with the reigning champion of these high-yield ETFs. This is a classic matchup, the established, flashy star versus the new, quieter challenger.
So first, meet the champ, YMX. If you've been anywhere near the income space, you've definitely heard of it. It's famous, or maybe infamous, for these gigantic yields it gets from really complex option strategies. But all that high reward comes with incredibly high risk. It's a total roller coaster, and a lot of investors have called it a yield trap, where those juicy distributions you get can get completely wiped out by losses to your principal.
And this is exactly where WPAY steps into the picture. It's being strategically positioned as the answer for investors who love the idea of frequent income, but are just completely fed up with the wild swings of a fund like YMAX. It's basically making a direct play for stability.
And this right here boils the whole debate down perfectly. YMAX is all about the spectacle, the huge yield that gets all the headlines and YouTube videos. WPA, on the other hand, is built on this idea of stability and consistency. It's trying to be a predictable coupon payment, not a lottery ticket. This is the fundamental trade-off you have to think about.
And you know what? The hard numbers really tell the story here. Just look at the difference in volatility. YMAX is way up there near 25%, while WPAY is under 18%. That 7-point gap means a huge difference in the day-to-day experience of holding these funds. One is just a much, much bumpier ride.
Okay, so with that comparison in mind, let's take a closer look at what makes WPA so appealing to a certain kind of investor. What exactly is the promise here?
Well, first, we've got to understand how it's built. WPSTA is what's known as a fund of ETFs. In simple terms, it doesn't go out and buy individual stocks. Instead, it buys a whole basket of other specialized weekly paying ETFs. This basically makes it an aggregator, a kind of one-stop shop for getting diversified weekly income.
And that structure leads directly to these potential advantages. That weekly income, it's psychologically really rewarding. The built-in diversification means you're not going to get wiped out if any single underlying strategy blows up. That leads to lower stress, and it really simplifies managing your portfolio. You just buy one ticker instead of a dozen. It's a pretty compelling package on the surface.
But now, it is time for a reality check. Because for all its promises, WPA comes with some significant risks that you absolutely have to understand before you even think about putting $1 into it. We need to look under the hood.
Okay, let's talk about the single biggest risk, the number one red flag, return of capital, or ROC. This is when a fund pays you with your own money. If the fund doesn't actually earn enough income to cover its promised distribution, it just takes a piece of your original investment and hands it back to you, disguised as a dividend. It feels like income, but I promise you, it is not profit.
And this quote from the source material just says it perfectly. With return of capital, you are eating principal rather than actual income. Every single time this happens, the value of your core investment shrinks a little bit. It's this slow, quiet erosion of your capital base, and if it happens over and over again, it can be absolutely devastating to your portfolio. And the red flags, they don't stop there. Because it's a fund of funds, it inherits all the risky stuff, like leverage and derivatives, from the ETFs it holds inside. It's also brand new, with basically no track record through different market cycles. And those weekly distributions and the return of capital, they can make tax season a potential nightmare. And finally, there's the lingering risk that this whole model is just unsustainable over the long term.
On top of all that, there's the fee. The gross expense ratio is 1.28%. Now, in the world of ETFs, that is high.
And remember, because it's a fund of funds, you're getting hit with a double layer of fees. You pay the fees of all the underlying ETFs, plus you pay the extra fee for the WPAY wrapper itself. That kind of cost structure can be a major drag on your returns over time.
So, we've seen the good and the bad, the promise of stability versus the very real risk of capital erosion. The big question now is, who on earth might this fund actually be for? And more importantly, is that person you?
First, let's just put its age in perspective. This fund literally just launched. It has barely any history. We have no idea how it will perform in a real downturn or a bear market. And notice that little detail at the bottom? The current management fee waiver is set to expire next year, which could make it even more expensive to hold.
So who is this for? Well, if you look at the trade-offs, WAPY might fit if you care more about consistent cash flow than a high yield, you have a moderate risk tolerance, and, this is a big one, you're willing to handle the tax headache. But if you're looking for your money to actually grow, you can't stomach drawdowns, or you want a simple core holding for your portfolio, you should probably steer clear of this one.
Ultimately, the best way to look at this is really clear. You have to treat WXOPA as an experiment. It is not a replacement for your core, stable income holdings like your dividend blue chips or your bonds. If you are intrigued by it, the most prudent approach is to start with a very, very small tactical allocation. I'm talking maybe 2 to 5% of your portfolio, and then you watch it like a hawk.
And that really leaves us with the final question. When it comes to your income portfolio, what are you really after? Are you chasing the high-risk, high-reward spectacle of massive yields? Or are you looking for the potentially lower stress, but way more complex, promise of coupon consistency? Your answer to that question will tell you everything you need to know about where funds like WPA might, or more likely, might not, fit into your strategy.